Welcome, curious minds, to another deep dive.
Great to be here.
Today we're tackling a really fundamental question that sits right at the heart of long-term investing, really, whether you're just starting out or you're already deep into refining your strategy.
Mhm.
And that is, where do you truly commit your capital? We're diving deep into the choice between two, well, titans of the investment world, the S&P 500, and a global world index, like the MSCI World.
Yeah, and this isn't just some academic thing, right? It really boils down to a fundamental, almost philosophical debate in investing. You've got the power of, let's say, concentrated conviction on one side.
Right, betting big.
Exactly. Versus the resilience you get from broad diversification on the other. Our mission today, looking at some really excellent sources we've gathered, is to unpack the arguments for each.
Okay.
We'll look at historical performance, obviously, but also scrutinize current valuations, that's key, and ultimately help you understand the trade-offs. Because there are trade-offs involved, so you can make a decision that, well, aligns with your goals and your comfort with risk.
Okay, let's unpack this then. Because looking back, say, over the past decade, I mean, one of these has clearly outperformed. No question.
Yeah, the S&P 500.
Right. And it's been largely fueled by something pretty dynamic.
Yeah.
That explosive growth of just a handful of U.S. tech and AI companies.
Yeah.
But, and this is the crucial bit our sources dig into, that amazing performance, it comes tied to a higher concentration risk. It's that classic investor dilemma, isn't it? Higher potential reward often means taking a bigger, more focused bet.
It absolutely does.
So let's start there. Let's make the case for the recent champ index, the S&P 500. For a lot of people, this index isn't just a benchmark. It basically is the U.S. market.
It's synonymous, yeah.
And its recent outperformance, well, our sources are pretty clear. It isn't just luck. It's been significantly driven by those tech titans, the Magnificent Seven, as they're often called now. These aren't just big companies. They're basically the architects and, well, the main beneficiaries of this whole digital revolution we're living through.
That's a really critical point. What the sources show is it's not just about size. It's about the deep network effects, the sort of ecosystem lock-in these companies have built.
Right.
I mean, think about it yourself. The operating systems on your phone or computer, the cloud infrastructure so many businesses rely on, the online marketplaces you use, a lot of that is controlled or heavily influenced by these firms.
Yeah, you can't escape them sometimes.
Pretty much. They haven't just adapted to the digital age. They've actively shaped it. They've built what our sources call these durable competitive moats. Makes it incredibly hard for others to challenge them effectively.
And it really feels like we might be on the verge of the next big thing too, doesn't it? Because the argument for the S&P 500 isn't just about past dominance. It also hinges heavily on the future, specifically U.S. leadership in artificial intelligence. What is the story there?
Well, this is where the case gets even stronger for the S&P 500 proponents, according to our sources. The U.S. is pretty unequivocally seen as the global leader in AI. Research, development, and crucially, turning that research into actual products and services, the commercialization part.
Okay.
And this isn't just wishful thinking. It's backed by, staggering amounts of private sector investment. Billions just pouring into R&D. Plus, you have a regulatory environment that, okay, it's evolving, but generally it's fostered innovation rather than, stifling it.
So a combination of factors.
Yeah, our sources suggest it's this unique mix. Access to venture capital, top-tier universities driving research, and maybe a culture that's more willing to embrace disruption.
So if you buy into that idea that the U.S. will keep leading, especially in AI, then putting your money primarily in the S&P 500 is presented as, well, a direct bet on that future. A concentrated one maybe, but direct. But that does raise a big question for you, the listener, right?
Yeah.
How sustainable is this dominance? And, what happens if the next big thing in AI doesn't come solely from these existing giants?
Yeah.
Or if regulators decide to step in more forcefully?
That's the risk. Our sources definitely caution that such high concentration, while it's been rewarding, it naturally attracts more scrutiny, and that political or regulatory risk might be, well, underpriced by the market right now.
Okay, so while the S&P 500 makes, a powerful case for concentrated growth, let's pivot. Let's connect this to a different but equally valid investing philosophy. If we broaden our view, many investors prioritize something else. Diversification.
Just safety in a numbers approach.
Exactly. And this is where a world index like the MSCI World really comes into its own. It's the classic, don't put all your eggs in one basket idea, just applied on a global scale. It spreads your capital across a much wider landscape. So someone choosing a world index is basically saying, look, I want a piece of the action from developed economies everywhere, not just betting everything on the U.S. What does that actually mean in terms of holdings?
Well, it means you get exposure to a huge range of developed countries. We're talking North America, yes, but also Europe, Asia Pacific,
Yeah.
companies from Japan, the UK, Germany, France, Canada, Australia, Switzerland, many more.
A much wider net.
A much wider net. By holding a portfolio like that, you're not just banking on U.S. innovation. You're capturing the economic output and the profits of, dozens of leading economies. Our sources argue pretty strongly this helps you hedge against the natural ups and downs of any single country's economy or political situation. You're diversifying by economic engine, not just by company.
And that kind of diversification, I imagine, can be a massive advantage when the U.S. market, despite its recent run, isn't always the leader. Our sources brought up some history on this, didn't they?
Oh, absolutely. And it's a powerful reminder. One of the most striking examples they highlight is the so-called lost decade for U.S. stocks, the 2000s.
Right, 2000 to 2009.
Exactly. People might forget this now after the long bull run, but U.S. stocks actually had a negative annualized return over that entire decade.
Ouch.
Yeah, really painful if you were only invested there. But during that exact same period, developed markets outside the U.S., and especially emerging markets, they delivered positive gains. Imagine the difference in your experience.
Huge difference.
It really underscores that market leadership isn't permanent. It rotates. Yesterday's winner isn't guaranteed to be tomorrow's.
And beyond just country risk, our sources also hit on how a global index helps with sector risk, which seems super relevant now given how heavy the S&P 500 is in tech.
Precisely. That's another key benefit. A world index, just by its nature, gives you more balanced exposure across different industries globally. You get more weight in, say, financials from Europe or industrials from Japan, healthcare innovators from various countries, consumer staples companies worldwide.
So, less dependent on one specific theme, like tech.
Exactly. It means if, for instance, the U.S. tech sector hits a rough patch, maybe due to regulations or changing tastes or just increased competition, your overall portfolio is cushioned because you have exposure to other healthy sectors and economies around the world. It's just fundamental risk management, really. Protects you if one area stumbles.
Okay, this is where it gets maybe a bit more complex, but really interesting. The S&P 500's performance. Impressive, undeniably. But our sources suggest it's come at a price. A literal price. We're talking about valuations.
Indeed. This is crucial. U.S. stocks, especially those big tech names we keep mentioning, they consistently trade at significantly higher valuations than companies elsewhere.
Higher multiples.
Higher multiples, exactly. A key way to see this is by comparing the price-to-earnings ratio, the PE ratio. For listeners who follow markets, this basically tells you how much you're paying for each dollar of a company's past earnings. It's a common way to gauge how expensive a market seems.
Yeah, maybe for folks newer to this, we could use an analogy. Like, think about coffee. You could get a really good cup for, say, $4 at a solid local place.
Right.
Or you could go to that super trendy, exclusive cafe across town, the one with all the hype, and pay $8 for their special brew. Both are coffee. Maybe both are even great. But you're paying a massive premium for that second one. Part of it might be quality, sure, but a lot is probably hype, brand, perception.
That's a pretty good analogy, actually, because our sources show something similar happens in the market. The PE ratio for the S&P 500 is consistently, often substantially higher than for a broad world index. You're just paying more for each dollar of earnings from U.S. companies on average.
You're paying for the $8 coffee, basically.
You're paying for the $8 coffee. And our sources also point out, if you look beyond the trailing PE, which uses past earnings, and look at the forward PE using analysts' future earnings estimates, that premium for U.S. tech can look even bigger.
Oh, so the optimism's already baked in.
A lot of optimism seems baked in, yes. It suggests investors are already expecting extremely high growth going forward. Now, that premium has been justified by amazing growth recently, no doubt. But it also makes the S&P 500 potentially more vulnerable if that growth doesn't quite meet those very high expectations or if sentiment just cools off.
Right.
If that $8 premium growth coffee suddenly becomes less fashionable, or maybe the $4 cup starts looking pretty good again, the price of the expensive one could fall faster.
It's that classic saying, right? Buy low, sell high. But sometimes buy high and hope it goes even higher feels very tempting in strong markets. Our sources definitely give us some history lessons here, too.
They do. We've seen these periods of U.S. overvaluation before. The sources vividly recall the late 1990s dot-com bubble. U.S. tech stocks hit absolutely dizzying valuations then, often way beyond any reasonable fundamentals.
Before crashing spectacularly.
Before crashing spectacularly. Now, today's situation is different in many ways. The companies are profitable, etc. But the core principle holds. Paying a really high price for any asset, even a fantastic one, inherently increases your risk. It just leaves less margin for error if things don't go perfectly.
So the global index, often having more reasonably valued markets.
It can potentially offer more of a margin of safety, as value investors call it, meaning perhaps less downside risk if the overall market takes a hit or if that narrative around U.S. dominance just softens a bit.
Okay, so we've laid out the arguments. Powerful case for the S&P 500's focused innovation. Equally strong case for the world index's diversified resilience. After digging into all this, what does it mean for you listening right now? Should you go all in S&P 500 or fully embrace global diversification? It really sounds like there's no single right answer.
That's exactly right. And that's often true in investing, isn't it? The best choice is rarely black or white. It really depends heavily on your personal tolerance for risk, how strong your conviction is about where future growth will come from, and your specific financial goals.
So different paths for different people.
Precisely. Our sources, thankfully, sketch out a few possible approaches, recognizing that investors see the world differently and have different comfort levels with volatility. So first you have path one, the conviction investor.
Okay.
If you really firmly believe that U.S. tech leadership, especially in things like AI, is going to keep driving the market for years, and you're okay with that higher concentration, well, then putting most of your equity allocation in the S&P 500 could be a perfectly rational choice for you. You're making a conscious decision. Accept more concentration risk for potentially higher, though less diversified, return.
Okay, makes sense. Then the flip side.
The flip side is path two, the diversification purist. This is someone who really prioritizes spreading risk broadly, managing potential downsides. For this type of investor, the world index is probably the better fit.
Sleeping well at night is the priority.
Sleeping well at night, exactly. Knowing your portfolio isn't overly dependent on one country, one sector, or even just a few huge companies. The world index is designed to protect against those single points of failure. It ensures you're participating in growth wherever it happens across the developed world, smoothing out the ride.
What if you kind of want a bit of both? You see the power of U.S. tech, but you also appreciate the safety of diversification. Is there a middle ground?
Yes. And that leads us to a very common and often quite sensible third option, a blended approach. Sometimes people call it a core and satellite strategy.
How does that work?
Well, you could allocate the main part of your portfolio, the core, to a broad global index for that wide diversification. Then you take a smaller portion, the satellite, and allocate that specifically to the S&P 500, maybe, or even a U.S.-only tech fund, to deliberately capture that concentrated U.S. growth potential.
So you get the broad base plus a targeted bet.
Exactly. It lets you tap into the potential upside of the U.S. market and its innovation engine, while still having that diversified foundation to hedge against the overconcentration risks that our sources consistently warn about. It's about finding that sweet spot, that balance between ambition and, well, prudence.
Good.
Leveraging the best of both worlds, perhaps. Hashtag outro.
Ultimately, though, the best choice, as our sources keep coming back to, is probably the one you can actually stick with through thick and thin for the long haul.
Absolutely.
Both the S&P 500 and a globally diversified world index, history shows they've both been powerful ways to build wealth over time. They deliver solid returns for patient investors, even if the path looks different.
The key, really, is to properly understand the fundamental trade-offs we've dug into today. That promise of concentrated growth versus the protection of broad diversification. And crucially, how valuations factor into that whole equation. You need to pick a strategy that genuinely aligns with your view of the future, and just as importantly, your personal comfort level with risk.
Yeah.
It's about investing with intention, knowing why you're invested where you are, not just chasing past performance.
And that wraps up our deep dive for today. We've peeled back the layers on the S&P 500's concentration versus the world index's diversification and that critical overlay of valuation.
We really hope this discussion has given you a clearer way to think through these important choices for your own portfolio.
And for you, our curious listener, maybe chew on this provocative thought. Looking ahead, in a global economy that feels like it's changing faster than ever, which force do you ultimately believe will be more powerful, more resilient over the next few decades? Is it the concentrated, high-stakes innovation of dominant players, mostly in one country? Or is it the collective, maybe slower but steadier, distributed growth and inherent resilience of the entire developed world, spreading your bets much more widely? Something to ponder until our next deep dive.